Hi guys, welcome to this channel. I believe finance, science and psychology are the keys to better life. One step at a time, let's create a snowballing effect in our lives. I'll be at your service to research concepts and share them in simple and fun videos. If you find this video helpful, please press the like button and remember to subscribe. It will help me tremendously to grow this channel and keep me going. The title tells a full story already that manias in economy boom will eventually end with panic sellers and the crash would be almost unavoidable. This book explores the development cycle of a crash and how a financial system has evolved to mitigate it. Under the current pandemic, high inflation and supply chain crisis, hopefully you will find this video helpful to understand what is going on in your economy and prepare yourself for the turbulence in the future. The main inspiration comes from the book named Manias, Panics and Crashes, A History of Financial Crisis by Charles Kindleberger. Since the content included is massive, so we will split this content into 3 videos, but still, we will not be able to cover the whole book. I encourage you to have a read of the book by yourself if you want to know more details. And as always, if you would like to support me, you could click on the purchase link below. The 3 episodes will be the development cycle of financial crisis, the biggest 10 financial bubbles. Then we will use 3 examples, the Japanese bubbles in 1990s, Southeast Asian crisis in second half of 1990s, and US stock bubble in 2000 to elaborate further. Lastly, with the 3 examples, we will find the crises were systematically linked, so we will explore the international contagion, domestic lenders of last sort versus international lenders of last sort, and fraudulent behaviors within economic boom. Now, let's make a start on part 1. In this video, we'll be covering Big 10 financial bubbles, cycle of financial crisis, relationships between stocks and real estates, Minsky's 3-part taxonomy, currency school versus banking school, people's greed. The Big 10 financial bubbles, the Dutch tulip bulb bubbles, 1636. It occurred in Holland during 1600s, when speculation drove the value of the tulip bulbs to extremes. At the height of the market, the rarest tulip bulbs traded for as much as 6 times the average person's annual salary. The South Sea Bubble, 1720, is the world's first financial crash, also the world's first Ponzi scheme. Britain had secured the rights to supply slaves to Spanish Americans in 1713. The South Sea Company bought the contract from the British government. It was assumed that the profits from slave trading would be enormous, which proved not to be the case. Speculators paid inflated prices for the stock, leading eventually to the company's speculative financial collapse in 1720. The Mississippi Bubble 1720, John Law, a financial theorist, gambler, and convicted murderer, originally from Edinburgh. Law's ultimately ambition was to replace the metallic currency with a paper currency, based on government debt that had been converted into company shares in France. Law decided to expand by acquiring the Mississippi Company. The company held a government-backed monopoly over trading with French Louisiana. At the end, the amount of the paper currency afloat was many times the actual reserve of gold and silver, and hyperinflation set in. The late 1920s stock price bubble. The financial boom occurred during an era of optimism. Families prospered, automobiles, telephones, and other new technologies proliferated. Originally, men and women invested growing sums in stocks and bonds. Billions of dollars were drawn from the bank into Wall Street for brokers' loans to carry margin accounts. The surge in bank loans to Mexico and other developing countries in the 1970s, with contractive monetary policies, which caused the appreciation of local currency, then leads to a massive inflow of foreign investment seeking higher investment yield. The bubble in real estate and stocks in Japan 1985 to 1989. The increase in the price of real estate fed the boom in stock prices. Bank stocks prices increased a lot as they own large amounts of real estate and stocks. The banks were eager to make more loans because they wanted to increase their size. The 1985-1989 bubble in real estate and stocks in Finland, Norway, and Sweden, due to the currency liberation around the same time of Japanese economic boom, attracted massive foreign investment, which created the bubble. The bubble in real estate and stock in Thailand, Malaysia, Indonesia, and several other Asian countries from 1992 to 1997, following economic boom in Japan, increasing investment from Japan, European, and United States has caused the bubble. The surge in foreign investment in Mexico, 1990 to 1993. Mexico's economy experienced expansion and structural change. This was associated with economic opening, market deregulations, and large inflows of foreign capital. In 1994, the sudden depreciation of Mexico peso pricked the bubble. The bubble in over-the-counter stocks in the United States from 1995 to 2000 is due to loose monetary policies and large foreign investment from Japan and Southeast Asian countries. Cycle of financial crisis. Mania, especially macro manias, associated with economy euphoria. Business firms become increasingly upbeat and investment spending surges because credit is plentiful. During the mania, the increase in the prices of real estate or stocks or in one or several commodities contributes to increase in consumption and investment spending. That in turn leads to accelerations in the rate of economic growth. Money always seems to be free in manias. The Japanese real estate company paid $625 million for the Exxon building in New York, even though the initial asking price had been $310 million. They just wanted to get in the Guinness Book of World Records for paying the highest price ever for an office building. The investor seeks short-term gains from the increase in the prices of real estate and of stocks, rather from the investment income based on the productive use of this asset. Then, an event, perhaps a change in government policy, an unexplained failure of a firm previously thought to have been successful, occurs that leads to a pause in the increase in asset prices. Soon, some of the investors who had financed most of their purchase with borrowed money become distressed sellers of the real estate or the stock, because the interest payments on the money borrowed to finance their purchases are larger than the investment income on the asset. The price of the assets decline below the purchase price, and now the buyers are underwater. The amount owed to the money borrowed to finance the purchase of the asset is larger than their current market value. Their distressed sales led to sharp declines in the prices of the assets, and a crash and panic may follow. During a mania, asset price will decline immediately after they stop increasing. There is no plateau, no mid-ground. The rush to sell these assets before prices decline further becomes self-fulfilling. The prices of the commodities houses, buildings, land, stocks, bonds crash to levels that are 30 to 40% of their prices at the peak. Bankruptcies surge, economic activity slows, and the unemployment rate increases. The thesis of this book is that the cycle of manias and panics results from pro-cyclic changes in the supply of credit. The credit supply increase is relatively rapid in good times, and then when economic growth slackens, the rate of growth of credit has often declined sharply. Virtually every mania is associated with a robust economic expansion. The appearance of a mania or a bubble raises the policy issue of whether government should seek to moderate the surge in asset price or reduce the likelihood or the severity of financial crisis when asset prices begin to decline. Virtually every large country has established a central bank as a domestic lender of last resort to reduce the likelihood of a shortage of liquidity. When asset price tumbles sharply, the surge in the demand for liquidity may drive many individuals and firms into bankruptcy, and the sale of assets in these distressed circumstances may induce further declines in asset prices. Relationships between stocks and real estates. There are two feedback loops from the increase in real estate prices and stock prices to the rate of growth of national income, from the increase in household wealth to the increase in household spending. As their wealth increase from the surge in asset prices, households save less from earned income and their consumption spend increases. From the increase in stock prices to investment spending, when stock prices increase, firms can raise cash from existing and new investors at lower cost and can undertake new projects that would be less profitable. Many bubbles in stock markets are related to bubbles in real estate. One is that in many countries, especially in smaller countries and those in early stage in industrialization, a substantial amount of stock market valuation consists of real estate companies. A second connection is that individuals whose wealth has increased sharply because of the increase in real estate values wants to keep their wealth diversified, so they buy the stock. The third connection is the mirror image of the second one, who has profited massively from stock markets by larger and more expensive first and second homes. Minsky's three-part taxonomy. We could use Minsky's three-part taxonomy to evaluate a firm to be either hedge finance, speculative finance, or Ponzi group. Hedge finance group, its anticipated operating income is more than sufficient to pay both the interest and scheduled reduction in its indebtedness. Speculative finance group, its anticipated income is sufficient to pay the interest of its indebtedness. However, the firm must use the cash from the new loans to repay part or all of the amounts due on maturing loans. Ponzi group, its anticipated operating income is not likely to be sufficiently large enough to pay all the interest on its indebtedness, so they need to either increase their indebtedness or sell some assets. Currency school versus banking school. The history of money is a story of continuing innovations so that the existing supply of money can be used more efficiently. Currency and banking schools has a different view about how to best manage the growth of money supply. Currency school, a firm limit on the expansion of the money supply to avoid inflation. Banking school, increase in the supply of money would not lead to inflation as long as these increases were associated with business transactions. The currency school view that the expansion of credits based on the availability of attractive business opportunities would eventually lead to inflation is correct. The banking view that an increase in the supply of credits was needed at the start of the economic expansion is also correct. There is no priori way to determine whether a central bank policy of holding the money supply constant, limiting the liquidity of the money market, or raising the discount rate at the first sign of euphoric speculation would prevent the manias that leads to crisis. Economists cannot conduct carefully controlled experiment. Also, in economic booms, the market will create new forms of money and near-money substitutes to get around the limit. Economists have debated the items that should be included in money for 2 centuries. People's greed. The business cycle is a standard feature of market economies. Increase in investment in plant and equipment leads to increase in household income and the rate of growth of national income. Hyman Minsky highlighted the changes in the supply of credit, which increased when economy was booming and decreased during economy slowdowns. A follow-the-leader process develops as firms and households see that others are profiting from speculative purchases. Heavily indebted borrowers tend to increase their indebtedness in the expansion to finance the purchase of real estate or stocks or commodities for short-term capital gains. The motive for these transactions was that the anticipated risk of the increase in the price of these assets would exceed the interest rate on the funds borrowed to finance their purchase. When the economy slows down, borrowers might be disappointed because the risk of increasing the price of the assets proved smaller than the interest on the borrowed money, so many would become distressed sellers. Speculations always develops in 2 stages. In the first, sober firms and investors respond to a shock in limited and rational way. In the second, the anticipations of the capital gains play an increasingly dominant role in their transactions. Lenders become so enthusiastic about the process that they fail to appreciate the endgame and provide an answer to the question of where the borrowers would get the money to pay the interest if the lender stopped providing them with the cash in the form of new loans. As we could probably see, inflation depends on the growth of money. Asset price bubbles depends on the growth of credits. Historically, euphoria has often spread from one country to others through one of several different channels, which we will now elaborate with 3 examples in the next video.